Well, hello, Matt. Good to see you for this next episode of Going Live with Good Soil. It's being recorded on our Good Soil Investment YouTube channel and on a live stream there. For anyone who wants to listen to it or watch it later, part of this is we're gonna go through a preview, an early preview of our earnings projections or Matt's model, which has been I think the most accurate of all the analysts, all the Twitter analysts and Wall Street analysts trying to predict earnings per share. Not to say that this will be spot on, who knows? But he's got a great record on this, so let's pay close attention when we get to that part. So we're on Twitter Spaces at the same time as YouTube Live, and we'll take some question and answers at the end. Just going over the outline now, how this goes, if anyone's new. So, Matt, first we'll talk about the macro markets as usual. I mean, it's really been brutal for us growth and tech stock investors, especially folks who are heavy on Tesla like us. It's been a rough few weeks, rough December, right? I mean, it's just something's changed, right? Yeah.
Yeah, I mean, there was a little bit of the kind of, coronavirus scare at the end of November, but, it wasn't looking too bad. Really, it was pretty strong for us, honestly, for a lot of the growth names. But yeah, just like beginning of December, it's been kind of day after day. A lot of the names that we like have been kind of just pounded relentlessly. So not the way we want to start our December, unfortunately.
No.
But it does seem like it's getting a bit overdone. I mean, there's not a lot as far as I can tell. And again, maybe we should say for the Twitter Spaces listeners, none of this is investment advice. We're just kind of trying to open source our thoughts here. So take everything we say with a grain of salt. We're not registered investment advisors. But it does seem that maybe some of the rotation out of tech, or some of the valuation, like the multiple compression that we've been seeing, is probably overdone in my mind. So it does seem like there's a lot of kind of good opportunities to scoop up investments right now if you have the kind of dry powder available to do so. But what's your take? I mean, we've been talking, I think, probably for the last couple of weeks about how market jitters and Fed rate concerns and everything.
Yeah, I agree with all of that. This transitory inflation being removed, basically Powell is backing off that language and suggesting they're going to start the taper earlier, and it just has a real magnified effect, a domino effect maybe on valuations. And I think, like you said, it feels overdone. It doesn't mean it can't get much more overdone. It can continue to get overdone, for till the end of the year potentially. I do see earnings. I feel like earnings, the Q4 earnings is sort of grounding in a way to as a backstop. Like as wacky as this free fall feels on the tech and growth stocks, some of the best ones getting hit really hard. Tesla, obviously, and some of the other high flyers that people like. I think the earnings of Q4, those coming out in January is going to be a real backstop, hopefully, to prevent, a much further decline if it continues to decline until then. That's my worst case scenario.
Yeah, that's kind of why I'm excited to go over the model today. I mean, a lot of the kind of commentary I've been seeing on Twitter has been kind of like macro commentary, or some I don't know, scare tactics is maybe too strong of a word, but like criticism. I've seen a lot of criticism of Elon for the way that he's handling this share, rather than doing like a private secondary. He's just kind of doing it on the open market via this kind of scheduled plan. And there's been a lot of focus on what I would say is kind of non-fundamental, kind of operational items. So hopefully we can kind of dive into how Q4 is likely to pan out, or maybe not likely, but one reasonable estimate of where we think Q4 could land, and how that translates to earnings and some kind of implied. Like if you do an annualized Q4 and do like apply a PE multiple to that, what does that say about the current valuation? Because like you said, I do think that provides a nice backstop, and frankly, more of a backstop than most people realize. I think a lot of people look at like robo taxis or some of these like big new things and say like, okay, that's kind of needed to get us back to, I don't know, 1,200 a share or something like that, and that's just not my view at all. I've been, I would say, vocal about like vocal, but an FSD realist. That doesn't mean that I'm
you've been one of the downer.
You've
been one of the people that's the Debbie Downers on full self-driving on Twitter. You've taken some slack for that too.
I haven't been like trying. I try to just be
I know. You're just
reasonable as
and you're
possible,
in Michigan, like maybe where you are, it's like not fitted well for those roads. Who knows? But yeah, go on. Sorry.
No, I was just going to say, like, I think there's plenty of upside from here, even if you give zero credit for full self-driving. And I don't think it's appropriate at all to give zero credit for full self-driving. Like, I think that's going to be a huge catalyst in the next 2-3 years. But I'm just trying to be honest about, where the current technology is. So anyway, a lot to kind of get into today. But I'm optimistic. It kind of hurts every day you're down a bit. Tesla's been getting like battered day after day. It's like today's a good day because it's only down 3%. Like, it's just been kind of bizarre.
I know it's rough, and I mean, ARK Investments getting clobbered too. I mean, it's just all the growth hype innovators are getting hurt bad, but I think they're poised for a strong rebound at some point. It's just how far can the rubber band get stretched before that rebound? The farther it gets stretched, the faster and more, the stronger the rebound will be, I think. But, you just don't know when, this market's going to stop selling these names. So many people have owned these names for so long and selling maybe gains, or I don't know. It's just when you have like mass psychology involved, that's what I find so fascinating about markets. It can be so irrational in both ways, on the upside and the downside. And it feels right now irrational on the downside, but the market is the ultimate judge, and in time will tell us where valuations should end up on these stocks. So time is on our side. If we could just make it a few weeks, I always think with this, if we could just make it a few more weeks till earnings with the stock market just staying flat, I'd love that. I don't need the stock market to go up. I just want it to stay flat. The earnings come out for the next quarter and the quarter after that. And then I'm like, all right, then our portfolio looks good from that point forward. But it's just in between now and then, there's just lots of vibrations in the market, such as today and the last few weeks have been a big down move.
Yeah, it's kind of funny because the move up to the 1,200s was, I think, probably faster than we were expecting, and the move down from there was probably also faster than we were expecting. So I think we're certainly kind of in this price exploration territory right now. But I do think Gary Black has some really good insights on this, and he's been saying for weeks now that he thinks hedge funds have kind of been front running a lot of these sales that Elon's been doing, and they're likely to close some of their short positions, when it gets close to Elon, completing his sales. And to me, that's a very kind of rational mindset. So if that is true, and of course we don't know if it is or not, but if it is, and then you've got kind of strong earnings numbers coming in the next month or so, and there's a host of other catalysts that I think are out there, then I think that we could have a pretty strong rebound. Not that it will necessarily happen, but it wouldn't surprise me if we did kind of bounce back up $300, just like we bounced down $300.
Yeah, I think the bigger point with Tesla's share price kind of declining, and I think there's an imbalance of buyers versus sellers, big time. Obviously, that's what brings the price down. But I think instead of I don't know if it's so much being driven by shorts, like hedge fund shorts this time. I think it's more about just weak longs who are getting out, who have gotten out, and who are waiting to get back in, or are waiting to get in to begin. If someone was making a decision to start buying Tesla, institutional investors kind of half in, half out, like, oh, why don't we get in? Maybe they're going to wait until this Elon selling is over now, and then there's weak longs, people who bought recently and they got freaked out by Elon selling, like, let's get out, and they just get out, and they'll have to get back. They'll want to get back in at some point, but there's just a lot of low conviction buyers of Tesla. I mean, you and I and most people that follow us are high conviction investors, long-term owners of Tesla for the most part, but there is a lot of weak conviction institutional portfolio managers, I think, that do own Tesla because they feel like they have to, not because they believe in the company. Maybe because it's part of the S&P and they don't want to get outperformed. But those weak conviction buyers or owners, I think, are the ones that are, creating sort of this imbalance at the moment of, making, resulting in the price going down every single day almost as the selling continues. So,
yeah, along those lines, I mean, it's kind of crazy. Even ARK is trimmed, but not in the way that they usually trim, of just kind of like maintaining their 10% target. They're down to like 8.1% in their flagship fund.
I haven't seen that
Yeah, so they're actually, thinking that they have better investment opportunities, if that's what, kind of that percentage portfolio implies about their conviction level. So I'm kind of shocked that they've gone so low on that. I mean, that they used to hang that around, like 11-12%, kind of like near the high end of where they had been, and they've just sold so many shares in the last I don't know, 2-3 months or so. They've had some drawdowns, which probably has been an indirect source of kind of Tesla price pressure, and probably price pressure in all their portfolio companies. But I think the rebalancing that they've been doing internally is pretty surprising to me. I don't think it makes sense.
It's different from the past. Yeah, in the past, I feel like when all their stocks are going down, they've kind of, I think Kathy Woods mentioned, they kind of fly to their safety as their highest conviction names, and Tesla was always that. And this is the first time you're not getting that signal from them, where maybe they're changing their thought process, or maybe they don't have as high conviction on Tesla as they used to. So yeah, it's interesting. Interesting.
Yeah, I mean, especially when you see them, like, kind of doubling down on like Robinhood and DocuSign and and Zoom. Coinbase and Zoom. Yeah, it's, I'm not saying any one of those is necessarily, not a great name, but I think it's surprising to me that they'd have higher conviction in some of those names than Tesla. So
yeah,
interesting.
I mean, Tesla is $1 trillion. It's just below now, but it's been about $1 trillion market cap company. I guess their thought process, maybe also they're being affected by Elon selling. They're just waiting until he's done selling, then they're going to go back in, but maybe they're thinking, Tesla maybe goes up 3x in best case scenario the next 2 years, 3 years, but they think these other stocks could go up 5x or something. Maybe that's what they're thinking. Who knows? But yeah, it is surprising. They've been one of the most vocal investors of Tesla for a few years now, and they're lightening up slightly, but maybe they'll get back in if it drops lower. We'll see. Yeah. Also, I saw the news before we kind of get into the earnings preview. So for those of you on Twitter Spaces, again, this is being recorded on our YouTube live channel, and we're going to go over Matt's earnings per share early preview shortly of Tesla and his investment model and spreadsheets for that. And that'll be on the video recorded, so you can go back and watch it anytime. But before we go to that real quick, what was interesting is it looks like Giga Berlin is having a lot of problems getting their approvals for now. First it was trees, now it's the water. It just seems like this is going to go on for a long time. I could see this going on for a long time, all these kind of issues. It's like ironic, like, the most likely outcome is the most ironic, Elon says, or whatever. And in a way, it's like Tesla got, the Giga Berlin up, really fast, and it looked like they had their, parade or whatever at their event at their factory. Everything looks great, all ready to go, and then all of a sudden all these things happen, and like the people that want to stop Tesla are like, oh, let's wait till they get everything ready to go, and then we'll flood them with these lawsuits and they'll never open. And I feel like that could be what's going on here. Like, there's a lot of bad actors trying to stop Tesla in Germany especially. So I mean, I'm worried about this.
I am too. I mean, it seems like a pretty serious, lawsuit that's been filed by environmentalists. And I mean, you're right. It's so ironic that like environmentalists would be stopping the progress of Tesla. So you have to wonder, is that the actual motivation, or is there some sort of, connection to entrenched, I don't know, labor or like VW, or, obviously we don't know anything like that. But it just seems completely counterintuitive that you would kind of protest the building of electric car factory over environmental concerns. Obviously, like that stuff needs to be handled right, and it sounds like Tesla Berlin is going to be using a decent amount of water. But kind of like suing to stop the progress is it could very well be like a meaningful impediment to production. It sounds like, from my understanding, not that I'm any sort of expert in German environmental law, but it does sound like they can at least start production, but they may be kind of limited in the amount of water that they can draw, and so therefore their kind of production output. So it's going to be very interesting to kind of see how that pans out.
Yeah, I mean, I think perception-wise, it'll really hurt Tesla if this Giga Berlin factory doesn't have any meaningful production for all of 2022 because of this stuff. I think that'll hurt the perception of Tesla's ability to ramp things up globally like that they can. But I think in reality, there is some insurance with China and Giga Shanghai upping production rates, and they could really max that out even more, I bet. And China will just like love Tesla even more if they could become like a main export hub of electric vehicles to the rest of the world, even if it's through Tesla, not XPeng or NIO. Like China would love just to be the manufacturer of the most electric vehicles, and they pretty much are already. I mean, they'll be even more so soon. And so, I mean, Tesla could be producing, 1.5 at a run rate of like 1.5 million or 2 million a year in China by the end of 2020, at the run rate by the end of 2022, if they do another expansion later on, because they think this, Giga Berlin is really going to delay things forever. I mean, I could see that happening. And then if they're producing so many cars out of China, exporting them to Europe, that's like their highest margin cars. That's what I understand is their highest margin cars are the ones they can produce in China and export to Europe. So if they can keep that going, that actually could be good for the bottom line in a way too. I mean, obviously the optimal solution is just have Giga Berlin up and running for logistics reasons, global supply chain, all that stuff. But their backup solution isn't that bad.
Although there could be issues kind of emerging there too. I mean, there's some reports of November production out of Shanghai being slightly down, potentially due to supply chain concerns. I'm not sure if that's necessarily true or not, but I think the wholesale numbers we saw last week were a bit of a disappointment. And there's been some whispers that maybe production has been impacted somehow. So if that's true, seeing how long that persists and how much that would impact any sort of ramp is going to be pretty important. I mean, we've been hearing on every earnings call pretty much for the last 24 months about how challenging these supply chain issues have become. But yet, despite that, they've like muddled through and you kind of delivered this exceptional growth. And we've been a little bit spoiled just on their execution, how well they've managed this. But I think we have to keep in mind that it is possible that there could be some things that they just can't overcome on the supply chain side. So it's too early to tell if that's really impacting things yet. I think even if it was a bit of an impact in Shanghai in November, even into December, it's still going to be a pretty big increase, I think, quarter over quarter on kind of deliveries. But I just don't want to take progress on Shanghai for granted, because it's not easy.
That's true. I would say if there's any country in the world that can help shore up supply chain issues quickly, it would be China. Just their government knows how to get things done, and they don't let regulation or bureaucracy stand in the way. So it just seems like if they can, although they do favor, I think the Chinese government would, if they had to choose between giving supply to XPeng and NIO or Tesla, they would probably choose their own if there was an issue and not demand was not an issue for any of those three. All things being equal, they'd give it to their own, I think. But aside from that, I think hopefully it gets worked out in China with the supply chain.
Yep, absolutely.
So yeah, I mean, Elon, a couple tidbits on Elon himself personally, before we go into the earnings model. Person of the year in Time, that was interesting. I watched the whole 35-minute Time video, and there's only 5 minutes spread out throughout the 35 minutes of Elon talking and answering questions. And it's basically a big marketing advertisement for Time's Person of the Year process. And they're just really trying to like, I feel like I didn't, then I saw it in a bridge, like someone put a cut together of just Elon's talking of the time of the year interview. And that's all people want to see. Like, I don't know why they split it up into like 30-second segments of Elon answering questions every 5 minutes in that 35-minute video. But yeah,
I actually didn't see that. I just read their article.
Okay.
Which I thought was pretty reasonable. I thought it was pretty balanced and, talked about some of his quirks for sure, but also talked about a lot of the real stuff that he had made progress on that I think the general public still is probably unaware of. I mean, he talked about saving taxpayers billions on launches and that sort of thing. And I'm like, hey, all that's great that sort of information gets out there.
Yeah.
But it was like hilarious. The article like led off talking about him like tweeting on the toilet and like making like jokes about that. It spent like 2 paragraphs about like splish splash jokes, and I was like, oh my gosh, like, that's your lead story. All right.
Yeah. And was it Walter Isaacson who wrote the article, right? Yeah. So
was it? I don't know.
I think so. I think he's writing the biography for Elon too. So this is
that makes sense.
His first stab at kind of writing something about Elon. So yeah, I mean, it's good exposure for him. Like he doesn't need exposure. We're in our own, universe, our own tunnel. Everyone listening to this, all of you and I, we're in our own tunnel. But realistically, it is good exposure, I think, like you said, for the masses, because there's so many people that don't really know who he is or what he's about. And some of those people do read Time or are exposed to Time magazine, which has been around for ages. So it is good exposure overall to the general public who otherwise is less aware of how important Elon is to society and so forth. So I like it. And the Hardcore History podcast he did, I listened to that yesterday, and I know you listened to it, Matt, and it was really impressive, his detailed knowledge of not just aircraft, and they're like each one's like mechanical advantages and defects, but also like the particular battles. And it was really, I was like, man, this guy's just like an encyclopedia of knowledge for everything. It's like, man, you don't, who needs a library if you have Elon in your house? Just ask him anything. He'll tell you whatever you want, and it's like, it's crazy. I was really impressed with his knowledge on that.
I was really surprised by that. I mean, he's never really talked about, to my knowledge, maybe I just missed it, but he's never really talked about like history that much. And then he just like shows up on this podcast and is like, talking about like the excellence of like the whatever particular engine, that had like the best production capabilities, and how you don't want to replace a part that was redesigned too many times. You don't want to do that in the Pacific Theater. It was really impressive. I mean, I think last week on this show, we talked about how he was like a polymath. Yeah. And it was just like one more example of like, here's one more, like well of knowledge. And apparently he bought etymology.com because he's like a huge etymology fan and like loves learning about like the history of
origination of sayings and words. Yeah. It's funny.
It was really I went and checked that out, and it's just like an orange. So it's like it's kind of like his x.com where he just bought that. It just has like a single X as the entire website. He hasn't
figured out what to do with it yet, I guess. Yeah. I'm sure he's got plans eventually, but yeah, it's that was really cool. If anyone hasn't checked it out, it's worth it. And then, all right, well, let's get to the Tesla earnings. That's coming up. What probably the 3rd or 4th week of January is when they'll probably announce, do their earnings report release and earnings call. And Elon's going to be on that earnings call to kind of help provide an update on the product roadmap. That's something we'll speculate on as time gets closer to that, I'm sure, further. So maybe, Matt, you want to try to share your screen and kind of walk us through. I know we have a couple hundred people on Twitter Spaces also listening. So the people on YouTube Live can visually see it, but maybe you can try to do your best to talk things through, and I'll see if I can help.
Yeah, sure. So I'll certainly do that. Anyone on listening on Twitter Spaces, feel free to jump over to YouTube Live if you do want to kind of follow along. You can always check it out later. We'll post this. I think it actually posts automatically on our YouTube channel. So if you want to see the details,
it does as soon as it's over there. Yep.
But I'll try to do my best to just walk through it. So can you see my screen all right now?
Yes, I see it.
All right. So, basically we just have the 3 most recent quarters, the actual results in here, columns K through M. My projections for Q4 are in column N there. So I've gone back through and kind of adjusted everything for the historical periods as well as I can. There are certain things like, for example, the full self-driving take rate. Tesla does not disclose that each quarter. So what I try to do is back out an estimate, or back into an estimate of what I think that spend
So you have
based on
18% right now, right? 18% for that for
Yep.
Q4.
So my estimates were 18%, basically just 18% in Q2 and Q3, and I'm keeping that the same in Q4.
And this is global or just in North America?
This is global, and maybe just
so
for
globally, 18% of people you're estimating are taking full self-driving with their delivery. They're taking that option.
They're taking that option. Yep.
Okay.
Which, is a bit of a change, actually, because last quarter I was assuming a pretty decent drop. I think I assumed it was going to drop from 18 down to 13%, because you had the introduction of full self-driving subscriptions.
Yes.
But what they said on the call, what I think Zach said on the call, was that they actually didn't see a drop off in the purchase option, despite kind of the introduction of full self-driving subscriptions. So that was surprising to me and a bit counterintuitive. So that does kind of create some extra margin potential over time. Maybe before we jump down too much, we should just talk about the delivery estimates. So I'm assuming just a modest increase in S and X deliveries, from 9,000 to 12,000, and then 265,000 3 and Y, to get to total deliveries in Q4 of 277,000.
How come such a modest, one question, how come, last quarter we got 9,275 Model S and X deliveries, which was a big jump from Q2 of 1,800 or 1,900. So how come such a small jump from Q3 to Q4 just to 12,000? What's your
It could be on the conservative side. I actually had it at 15,000 just this morning, and I decided to drop it down. It seems like there haven't been as many X deliveries as far as I can tell, as when they were kind of running at full production. So I think when they're running at full production in a quarter, I think they get around 20,000 deliveries, and it seems unlikely to me that they're running anywhere near that right now, with a lot of the kind of ramping that they're trying to do with Plaid. So maybe it's 12, maybe it's 15.
It could be as high as 20,000 by any chance, like with lots of Model S deliveries, or no?
I don't think so, because total capacity is 100,000 per year, I think, right? Out of those, and so I think I'd have to go back and check historically. Maybe I have the data in here, but they hardly ever, like Q4 2020, it was 19,000. So even
that was S and X combined, is that right?
S and X combined, yeah.
So this quarter it's mostly all S's, and you're assuming, like, even if they're maxing out the S's, maybe it's like 11, 12,000 S's or something, and maybe a couple thousand X's or something. Best case. So you just put 12,000. Okay.
Yep. So that's kind of the thought process there. I had this a little bit higher too, the 3 and Y, this morning before I went and kind of changed it down. I do think there's potentially some truth to the rumors of supply constraints in China, and if that's true, then you wouldn't have. I think a couple of weeks ago we were thinking maybe this could be 300,000 or so, but after the wholesale report last week that came out of Shanghai, and I just think a more middle of the road conservative approach is warranted given what we know right now. So that gets to 277,000 deliveries for the quarter. And then, so obviously 18% of that total would be full self-driving purchases. And then the thing that's new this quarter is that you have subscriptions. So I'm taking an estimate of the previous quarter's subscriptions and then adding 10% of new sales to that total. So this would be full self-driving subscriptions should be something of like a cumulative aggregate over time. So as you get more quarters under your belt of having subscriptions, you're going to generally have a lot more subscriptions being added than being canceled. So that's a way where essentially the global full self-driving take rate is going to be higher than 18%, because some amount of those subscriptions will be.
So you have full 27,700 full self-driving subscriptions cumulatively to date by the end of Q4. Okay.
Yep. And that's just an estimate. We don't really know the details on those. So hopefully Tesla starts breaking that down over time, but it's right now they don't. So that gets to total automotive revenue, excluding full self-driving and credits, which is kind of my own metric, but I think it's helpful to kind of get to like pure play automotive revenues of 13.4 billion. Then I'm assuming that there's not any incremental recognition of deferred full self-driving revenue.
Wait, one quick question, Matt, about the full self-driving subscriptions, the 27,700.
Yep.
That's as of the end of Q4 or at the start of Q4?
At the end of Q4. Yeah.
Okay.
So it
Do you
does
back
build
out
slightly.
Yeah, do you back out any of, because some like a large percentage of those full self-driving subscriptions, since it's only been live for a couple quarters now, would probably only sign up in the month of December, so they might not even pay much for the whole month, for the whole quarter, right? But
Yeah.
it's probably overall it's somewhat marginal for the whole earnings estimate, but it's interesting to think about.
Yeah. So there's a concept in financial modeling called the mid-period convention. So you kind of, for something like that, you assume that you would basically count the revenues, excuse me, like in November, and multiply those by 3, and that would be your estimate for that period. So that's essentially what I've done here. It's hard to tell, but they launched this. I forget exactly which month they launched this in Q3, but I think it. Do you remember off the top of your head, Emmett?
Yeah, I think it was in July. I think it was July.
Oh, was it July? Okay.
Yeah.
So based on my modeling, I assumed it was 20 million in Q3, and then it jumps to 55 million in Q4. So part of that would be, I thought it was a little bit later in Q3. So
maybe it was end of July or early August, but I thought it was July. I thought it was around Independence Day, somewhere around there, but I could be wrong.
I mean,
I'll Google it while you're talking.
All right. It's a small percentage of the kind of overall revenues and margin, so it doesn't drastically move the needle one way or another. But it will be, I would say, increasingly important over time. But it's going to be hard to fact check that if the IR team doesn't give us more details. So maybe just while you're looking that up, I'll just comment on a couple of things.
July 22nd, I think.
July 22nd. So you had,
I think, that's why I see a Consumer Reports article about it. Yeah.
So basically, you only had like 2 of the 3 months, which would have been available for revenues in Q3. So you'd need to extrapolate that, like the 20 million that I was estimating would basically be like 30 million, and then you're adding in another quarter of higher delivery volumes also. So to me, that looks about right, that it should, more than double, almost triple.
Yeah, I would say so. Yeah. July 16th. Although you have a whole bunch of, it should go up. I mean, you have a whole bunch of people maybe waiting to get it that all sign up at once mid-July, as soon as it opens up. And then, so maybe the take rate just is not as high going forward for new. It's hard to say. Yeah, we'll see. It'll be very interesting. It's a little bit of a variable.
And I would think once they actually get full self-driving to kind of wide release instead of this beta, the subscription rate should go up quite a bit. Because, I mean, if I were in a position to consider subscribing right now, I don't really think I would, because I've got to get my safety score up to get the benefit of the features, other than navigate on autopilot, which is like really the only one that's that useful right now. I mean, the other stuff's kind of almost like a gimmick is too negative of a term, but like the driving in a straight line on city streets is not particularly useful. I don't think.
You'd think Q1 or Q2 sometime it'll be more widely available. I mean, they're progressing pretty fast with these new releases, and Elon seems very confident with this new release. He's saying it should be called 11.0. So a few more confidence intervals, signals to me a few more 9s, maybe a couple more 9s of safety, hopefully, and maybe that's the point where they can wide release it. But they'll still want people to be sitting in the car and pay attention, and they'll have to sign all, electronically agree to all kind of disclaimers every time they turn it on and such.
Yeah, and you can imagine when they do get to that point, then you'll have this huge kind of margin benefit of recognizing a lot of this deferred revenue that's been building up on the balance sheet.
Yeah. So 1.7 billion, is that what you see, right?
Is my estimate. I mean, the total deferred revenue balance is higher than that, but this is the portion that I believe is applicable to full self-driving. So I mean, this balance just continues to kind of grow at an exponential rate, and at some point they'll start recognizing that, and that'll flow through the financials. which obviously that's a benefit that I think a lot of analysts will adjust out. So like you could imagine if there was
a
a
one-time thing.
yeah. So that's a one-time thing. But then you have to also remember that like half of the revenue for full self-driving for current period sales is still not recognized. So that's not a one period thing. So even though you're deferring 42% of full self-driving revenue, there's still 300 million in sales or a recognition of new. So if you could recognize all of that right away, then there'd be 575 million of full self-driving recognition. So that's not a negligible impact to just be able to recognize current period sales, and that's something that I don't think most analysts are accounting for.
Yep.
So then moving down, credits have been a little bit low the last two quarters.
Yeah.
And I believe based on I think the accounting for credit sales, it's very similar to accounting that I used to see when I was doing renewable energy credit sales, where they're essentially recognized in the period when the credits are transferred, not when the kind of underlying delivery takes place. So like I would always talk about them as this phantom asset because there was no journal entry at the time the credit was generated. So you can have like a huge buildup of production, and then you can essentially just deliver the credits whenever you want to, and you get this kind of big influx both of cash flow, but also of earnings. So it seems likely to me that that's something that's been going on in Q2 and Q3 when those deliveries were going up, but credit sales were going down. So I've assumed a modest increase here to 400 million. It wouldn't surprise me if that was actually as high as, I don't know, 750 or 800 million. Just because
I wouldn't be surprised. Yeah, the phantom asset is a great way to describe it. Like, I wouldn't be surprised if it was a phantom asset, if it was like 2 billion of phantom assets sitting on their balance sheet there that it could start like materializing when they, but although that would be based on what they
it doesn't
sell
even
it
go on
for.
the balance sheet. It's like there's no
it's
way
like
to
a 2 billion phantom asset sitting there.
There's
that
no
one can
journal
see.
entry at all. It's the most bizarre accounting. It
until
makes no
they
sense.
decide to deliver it or sell it, or until they transfer it, right, and they sell it. And but they also, I know the mechanism of them selling it is dependent on what the buyers are willing to pay. Like they probably don't want to sell it for pennies on the dollar. I think Elon has made comments in the past they're selling it for like half or even less than half of what they're worth or something. So there's a lot of variable valuation in that phantom asset no one can really figure out, but at maximum value could be like billions of dollars of a phantom asset, but in reality they might only sell it for a quarter of what the maximum value could be.
And so it's certainly possible that kind of those low credit sales we saw in Q2 and Q3 were just the result of decreases in price rather than kind of like building up this phantom asset. So if that's the case, then maybe we can expect a continued downtrend in credit sales.
But it would be great is if we could find someone, a specialist who's call it like the phantom asset interview or something, just a specialist on the energy sales. I mean, there's got to be people out there that like their livelihood is revolving completely around buying and selling these regulatory credits, and they understand the ins and outs as well as anyone. If anyone who's following us or wants to tweet Matt and I an idea of someone who can shed some more light on this phantom asset, it would be really cool. I'd love to interview someone who understands it better, because it is a huge variable that no one can really figure out. But the more we can understand it, the better.
And assuming that they're using the same accounting as I was using in my old job, which I believe they are, then really you would just need someone that has the knowledge of these different credit markets. Because I understand the accounting, but there's these markets in California, there's markets in Europe, and who's got what percent of their obligation filled, and kind of what those contracts are. I know there was a big deal with Stellantis, but I haven't seen any news on that in the last like 12 months.
Me neither.
So if anyone knows more details about that, we'd love to kind of
please reach out to us. We'd love to interview you about it. All right. Sorry to disrupt. Keep going.
No worries. So I have a separate kind of more detailed model that I've excluded here that builds up lease revenue.
I've seen some of that. That's pretty complicated.
It's a bit of a monster. So I won't go into that one. But there's an output from that feeds in here. And so I'm assuming 410 million of lease revenue. And then I've got energy revenue increasing about 30% quarter over quarter. And then services revenue also increasing about 30%. Services actually declined in Q3, and energy sales were basically flat in Q3, which is a little bit surprising to me. But I think we're probably going to see a big increase in megapack deployments on energy.
We have energy revenue at 1.1, just over $1 billion, and 48 million.
Billion,
1.048. Okay, and services 1.028 billion. Okay.
Yeah. And services, we'll talk about this more in a minute, but services includes used vehicle sales.
Oh, that's big. Yeah.
Which is, historically services has been like a money losing part of the business. You think of like supercharging and like premium connectivity and a lot of things that presumably they run close to break even. But with used car prices in general and used Tesla prices in particular being so resilient right now, this has become a source of increasing margins over time. So maybe we'll touch on this in just a second when we get down to margins. But adding all that together gets to total revenue of 15.893 billion, which is a increase of just over 2 billion from Q3, if this is correct.
Okay.
So then one of the things that I do differently in this model versus I think anyone else is I break out what I call core manufacturing gross margin. So think of this as automotive margin, where you exclude full self-driving, like the gap portion of full self-driving revenue, and regulatory credits. So I've kind of back tested this, like I was saying at the beginning. And so in Q3, that increased to 26.7% based on my estimates. Which was a huge surprise, I think, to most people.
Yeah, it's big.
But in Q4, I think you've got those same trends. You don't have Berlin and Austin online yet, so you're not getting like the depreciation drag on from those plants. Instead, you just have like kind of continued operating leverage coming out of Shanghai in particular, but also Fremont. You've got the Model S line and X line contributing a little bit more than they were in Q3. And then on top of that, probably the bigger driver is you have price increases, which have been stuck in the backlog really in most of Q3, I think. So some of those will start to come through in Q4.
That's a big deal, those price increases. Yeah, I think 28% is, I mean, I guess I'm just a Tesla bull and biased, but I feel like the total revenue number you're being kind of conservative on, and the core manufacturing you're being the gross, I feel like it could be like 16.5 billion total revenue and like 29 or 30% core manufacturing gross margins. But I'm just so bullish on Tesla. So probably
we'll do a couple sensitivity analysis once we finish getting through this. We're almost through. I mean, really gross margins, the most important stuff, and then we can kind of blast through the other stuff and we'll run some sensitivities. But so 28%, I agree with you. It could be on the conservative side, but I think at least it stands to reason that there should be a at least 1%, I think, increase in that core manufacturing gross margin this quarter for those reasons, unless there's just like kind of crazy supply chain issues that we're not aware of, which is possible, but I think it's unlikely. So then you get gross manufacturing, or you get automotive gross margin. Then you add back in your full self-driving and like acceleration boost and some of those other kind of like software-based margins. Add back in your credits, and you get to total automotive margin of 4.578 billion, which translates to 33.1%, which is a like phenomenal number that like analysts 2 years ago or even 6 months ago probably thought would not happen.
Wow.
So this, we've said this a couple times, this could be a local high. I mean, I think as you get Berlin and Austin online, that's probably going to drag margins down a little bit up until they get to the point where they're kind of producing at margins more like Shanghai. Maybe and they probably won't ever get quite that high, but you'll have that kind of ramping issue that we saw when Shanghai ramped. So putting all that together, energy gross margin, I'm assuming that's zero. Historically that's kind of bounced around between minus a few percent and positive a few percent. And then services has almost always been negative. It was minus 1.8% last quarter. I'm assuming that just is zero, in a slight improvement to zero in
the
Q4.
Used car sales stuff.
Exactly. Okay. Yeah. The used car sales, I think, is probably the biggest thing.
Okay.
And you've kind of seen that over the course of this year. I mean, it went from minus 7.8 minus 3.7,
Yeah.
minus 1.8. So you've seen during this period of time when used car prices have been rising, that gross margin has been rising a little bit as well.
Yeah, I've seen anecdotal stories going around this quarter in particular of people saying, "Oh, I traded in my Model 3, which had full self-driving on it for 45,000, great price, and I saw them resell it without full self-driving for 55,000 or something." It's like a loaded Model 3, and so you see these turnaround stories by Tesla, these anecdotal turnaround stories of them. They must have really impressive margins on the services for, I would say, for the rental. I mean, not for the rental, for the resale value stuff. So yeah, I could see that being zero or even positive, but we'll see.
I think in one thing I get really excited about that I think a lot of people forget is that in Q2 of next year, that they start getting the original Model 3 leases back from 2017, I think it was, because those were 4-year leases.
I remember.
And so those
leases,
Tesla required basically that the users couldn't buy them back.
Yeah.
So Tesla's going to have this influx of new used vehicles with an incredibly high residual value. So that's going to be like a gross margin boon in Q2 that I think most people have just kind of forgotten about.
Yeah.
So that's the most exciting thing on the horizon, I think, on services. But anyway, total gross profit of 4.578 billion, or 28.8% all in.
Okay.
I've assumed a kind of modest increase on R&D up to 672 million. Same thing on SG&A up to 627 million. And then stock-based compensation increasing a little over 100 million. And that is potentially on the conservative side as well, because I think it's likely that Elon's CEO compensation plan is starting to kind of wind down the quarterly gap hit that's going to be providing. But with the workforce growing and these SBC awards for new employees, I think that's my thinking is, anyways, and I could be wrong on the exact math of how that pans out, but my thinking is that the kind of new employee SBC is going to outstrip Elon's kind of decreasing CEO performance package impact. So that gets to total operating income of 2.686 billion. And then we'll just kind of zoom through these other items down here. GAAP net income of 1.88 billion attributable to common stock. GAAP income or earnings per share of 1.67 billion, and then adjusted EPS of $2.20.
Wow. So that's kind of your conservative number at the moment with this model. Your somewhat conservative numbers, $2.20.
Yeah, and I've put out a thread, I think last quarter, where I basically said, like, I don't want to try to go high. I don't want to try to make like aggressive assumptions or bullish assumptions on everything. I want to try to give like a middle of the road estimate for each one of these numbers to arrive at a middle ground. So this is kind of like my middle of the road, like P50 probability of what I think could happen. Wouldn't surprise me, if like there's some more bad news than I expected, and maybe it sounded like $2 or more good news than I expected, and it's $2.40 or something like that. So maybe we can take a stab now at like, let's run through some of your assumptions. What would you have changed on some of these, and we can look at what that earnings per share impact would look like.
Yeah. So go back to deliveries of Model S and X to 15,000.
All right. Oh, and price increase. We didn't talk about that either. I basically assumed a modest price increase on 3 and Y translating through here, but nothing on S and X. So if you want to adjust any of those, we can do that also.
Yeah, no, I think that's fine. I mean, the Model S and X should be a little bit. I think there's a higher ratio of long range Model X is getting delivered now than the Plaid. So maybe we want to lower that price. I'm thinking,
just like 115 or something like that.
Yeah, 110 maybe. I don't know.
Right. This is like inclusive of all the options and everything, like your paint color and all that.
Yeah. I just think there's a lot of people that are doing the long range Model S basic. No, not too much stuff. Just that's my suspicion. And then the Model 3 and Y, let's move that up to 275. So let's say, okay, 290. And what else was I looking at that I thought was low?
You mentioned the core manufacturing margin, but do you want to adjust full self-driving or any of those other things?
No, I think that's fine. That seems about right to me. I'm just putting my own personal estimates in this it's a little higher.
Oh,
More
credits.
biased.
That was the other
Credits.
one.
Yeah. Let me put that let's put that at 600 million.
All right.
Okay, because I think this could be a surprise. Every few quarters they have kind of a back. It swings back. The pendulum swings back towards, and they've been selling so many cars the last few quarters. They have so many credits accumulated. They're going to be selling more.
I mean, 600 could even be a low ball here.
Yeah, let's move up to 750. Yeah, let's move up to 750.
So now I'd say it's on the aggressive side, but not unreasonably so. I don't think
it's not it's not unrealistic, but it's aggressive. Yeah, it's possible. And then the what was it? The ZV credit. Okay. Go to the services margin. Where's that? A little further down.
Do you want to do the core manufacturing margin though? I thought you were saying
do that. Yeah. Put that at 29%.
29. All right.
Yeah.
So almost
okay.
It's just a 2.3% increase. That's actually not that crazy.
Not that crazy, but I think they have operating leverage. Yeah. So services, let's make it positive 2%.
Yeah. So even that doesn't move the needle too much. It's only 21 million.
Yeah.
But it's
okay. It's not too much.
A little bit.
Yeah, I mean, these are all like realistically positive things I'm thinking. I'm not going like outside the box, like the best scenario. I'm thinking like, what's my top quadrant of positive, like the bottom of the line, 75%, line. You were at the 50-50. Now I'm at like the 75% line of reasonable positive estimates in my mind. So, all right, so let's go down. I guess that's all the main things. I mean, I'm not going to change the cost, SG&A or anything like that. So,
yeah. So those couple changes are to get to $2.67. So a pretty drastic change in earnings per share impact.
Yeah. There. Wow. So that goes from the last quarter, as you can see on the spreadsheet, was $1.86, which was a huge surprise. And this quarter, it could be $2.67, another huge surprise. So
one other thing that may be aggressive here is they've had a very low effective tax rate the last couple quarters. Let me just see what this is.
Okay.
So wait, that's not right. 2.5%. Oh God, I grabbed the wrong line here.
Okay.
So in Q3, it was just under 12%. I'm assuming that's going to normalize back to 25% because 12% just seems way too low to me. Yeah. But let's assume it's 15% instead of 25%, which is certainly possible. Then that gets to 296.
Wow.
So that could be another impact as well. That just kind of moves that bottom line number. And I don't know what consensus is, right? I haven't checked in a couple days. Let me pull it up here. So consensus for Q4 now is, let's see, 192.
Oh my gosh.
This would be a pretty drastic beat on that number.
Yeah.
But huge. 192 just seems like dumb to me.
Yeah.
That's like the most conservative number I could really reasonably fathom. So
yeah, that's what I'm saying. Like we just gotta make it hope the market just kind of stabilizes at the very least for the next month until these earnings come out, because it's there's no way earnings are below $2 in my mind, and more likely it's $2.50 or potentially higher, maybe as high as $3, like we're saying here, possibly, but it just seems I mean, the institutional portfolio managers, the analysts, sell-side analysts, and buy-side analysts, most of them don't understand Tesla enough on this scale to understand, how much it's growing. I think Elon tweeted the other day, or confirmed a tweet the most underestimated thing is underestimating Tesla's, potential going forward or something. And I think that's true. I think a lot of these so-called quote-unquote analysts, they're not just following Tesla stock. Like you and I, we follow Tesla stock with 50% or more of our time. Most analysts have several stocks to cover, and they're just not they haven't been doing it for years either, and they're just kind of piggybacking off of other people who are covering several stocks. And it's just it's really an information advantage for us retail investor type folks who focus on Tesla.
Yeah, no, I completely agree. And just to give an idea of the kind of backstop that we're talking about on this core business. So you assuming 296, which is maybe on the most aggressive side, but let's just
And real quick,
as
just for
the number
anyone who's listening on Spaces, we're also on we're talking about a spreadsheet Matt is showing on YouTube Live right now on the Good Soil Investment YouTube channel. I know a number of people have left Twitter Spaces to I think go to the YouTube Live channel, but if anyone else who's joined recently in the Twitter Spaces wants to see what we're talking about, they can do that. But this is recorded; it'll be shown on our YouTube Live channel as soon as we're done recording. Recording this. Anyway, sorry, Matt. Go on.
Yeah, no, that's fine. So one of the things I like to do from time to time, just as like a very kind of back of the envelope, just rough check on kind of how the core operations backstop the price, is I just take the most recent quarter and annualize it. So if you take this 296, which is admittedly aggressive, but if you assume
say $3, let's say $3 aggressive, okay.
So if you annualize that, it's like $11.90 of like annual earnings. And then at the 930 stock price, which it's trading at right now, that's a PE of just 78, which is like,
oh my gosh,
crazy low for a company growing top line by 50% per year.
Yeah.
And with a huge technology advantage and with huge optionality on top of that, with all the things that we talk about, like autonomy and
got to load up the truck. Yeah, as many shares as you can. Yeah, that's insane.
And I forget do you remember what was my was it 226 or something like that? Here, let me just back it off.
Yeah,
undo some of these changes to get back to my initial model if I can. So then we're at 227. Then if we do the same thing, the 227 annualized, change my formatting here. Sorry, everyone. So that's just over $9 on an annual basis, and then the 930 current stock price over that is a PE of 102. So even that seems really conservative. And if you were to do a forward PE, which is the way most analysts do that, it would be even lower, because your 227 would be probably your lowest earnings per share of any quarter in the year 2022. So I think if you do it that way, it'd be, I don't know, it probably wouldn't be cut in half, but it would be closer to, I don't know, 60 or 70. So like the PE is going to backstop this company. I feel pretty strongly about that.
I agree.
And so if
just give it a long enough time horizon, it's going up significantly from here. It doesn't mean the stock can't go to like $500 so irrationally in a downturn. Like that could happen. So just be careful. The stock market can be very. I mean, Tesla was at split adjusted $40 a share not long ago, a few years ago. So it was that low for a few years. Going up to 2018, 2019, and many people who owned it all that time saw this coming, where saw the success of where it is now coming for year, and we all thought it was crazy that the stock was so low. And I kept thinking I was like, I must be going crazy because something either I'm way wrong or the market's way wrong, but I'm sticking to my guns, but
this is the exact model I used in 2019 to kind of load up my truck personally. Cause I was like, the analysts are wrong. Like maybe I'm wrong, but I think I know this stuff. And they were assuming a retraction in gross margins from where they were in Q3 of 2019. And that just made no sense to me, because Fremont was going to continue to be optimized and you were going to add in Shanghai afterwards. So like, I do think this kind of information advantage that we talk about is legitimate. And I think we're at a really reasonable backstop position from a share price perspective right now.
Yeah, absolutely. So we talked a long time about that. Let's, Alex, if you're okay. No, it was good. I think it was good for everyone. Good for me. I mean, that was the first time I really went in detail with you about it this quarter, and it was good to see. And just so everyone knows, Matt, how close were you the last couple of quarters? You got to put up that chart again. I think you put some charts up, and you're such a humble guy. I know you don't want to like tout your own, accuracy, but what was it the last couple of quarters?
Well, I'm so humble that I like make these charts of my accuracy. So maybe I'm not that humble, but
we'll keep it private unless I force you to show it.
So here's like my historical accuracy chart. So the figures in black here are the actual numbers that Tesla posted. And then the figures in green are my estimates, and figures in red are Wall Street's estimates. So like Wall Street has every quarter except for Q4 2020, they've been significantly under Tesla's actual estimates. So like they just don't seem to learn their lesson, and part of it is complicated because like it's hard to do the detailed build up on like what percentage of revenues are full self-driving related, and then kind of what amount is currently recognizable. That changes over time, and it's a decent amount of work to kind of track that. So I don't completely begrudge them, but they've just been so wrong, and it's like, when are you going to learn? So that's where they were. I haven't added in Q4 here, but if we're at roughly 227, and then
so approximately half the quarters you've been like spot on, like dead accurate, and you've had a couple misses along with the street. The street has had missed every time, but you missed in Q2 or something, and but you've been really close a number of times. You've been like very like within a penny or something last quarter. So
the absolute value of my variances has been 19% on average, and the absolute value of Wall Street's variance has been 63%, which is like horrible. But it's heavily weighted towards like 2 years ago when they were just like off by 100% all the time. But even still, they've been not super accurate in the last couple of quarters.
Yeah, I mean, if you take out your outlier of Q2, of 2021, you've been super close this year. I mean, that's the one quarter but everyone was off that quarter, I think, if I recall. So
so Tesla really surprised on that. I can't remember the exact situation that was going on there. I think there were some supply chain concerns, and
they were just overcome it.
I was kind of thinking there was a reasonable chance that their cost structure would have increased more than their revenues did, but I was wrong. They like look at this jump that they had in that period. Kind of drastic. They've been increasing a couple cents here and there, and I was still just assuming they would follow that trend, just increasing a couple cents, and instead they just kind of had a step change, and then again in Q3 they had another step change. So and
amazing. So let's get to, I mean, Alec, if it's okay, he's running our back end stuff. Let's do questions for like 15 minutes, Q&A for 15 or 20 minutes, because we haven't done any, we've gone into this, and we'll just answer as many questions as we can in 15 or 20 minutes. We'll try to put a hard stop at like 10:55 a.m. Pacific time, if that's all right. From Melody of 1974, question: have you bought any Tesla on this downturn? I wish. We're so fully vested in Tesla. It's tough to buy more when you're already maxed out on it. I wish I had dry powder. I would have had to sell Tesla at a higher price to get enough dry powder to buy more, but I didn't even want to sell it when it was at $1,200. So no, I have not bought more. I'm tempted to figure out ways to buy more. I just haven't done it yet. No. Yeah. Good question though. Next question, Digital Blade CA question: what do you think macro would look like for growth stocks with inflation fears in February and March? Matt, do you have any thoughts on that?
I mean, it's so hard to say. I mean, I kind of think this will have mostly blown over by that time. It's certainly possible that we'll kind of be in either a worse downturn or some sort of continuation of the uncertainty. But a lot of these growth stocks, I think, are starting to look like value stocks for the reasons we just pointed out with Tesla. I think people who aren't following this closely look at Tesla and say, geez, it's expensive. It's $1 trillion company. And it's only got $50 billion of revenue. But that's a short-sighted, that's an overly simplistic analysis that will give you the wrong answer. And so I don't know how long it's going to take for this to pan out, but I do think that a lot of the growth stocks, at least the ones that continue to execute operationally, their operations will either force them to grow into their valuation or to raise the valuation.
Question from D. What's after Elon exercises all his 12 tranches of his performance plan? Will he sign a new plan or announce some sort of multi-year departure transition plan away from Tesla to focus on Mars? I wouldn't be surprised if there's a new plan, but I wouldn't be surprised if there's not. I don't know. I'd say it's like 50-50 whether it's a significant possibility there's a new plan that gets put in place in the next year or so, just to keep him attached to the hip with Tesla for longer and such. But I also wouldn't be surprised if there is no plan. I mean, how much bigger can a plan get? How many trillions are you going to give him? Imagine the backlash from Warren and Sanders and such, saying Elon's got a $10 trillion compensation package if Tesla gets to $100 trillion valuation or something like that. So it would just so maybe for that reason he's just going to say, nah, I'll just be product architect long term or whatever. What do you think?
Yeah, I just side comment. I love the irony of Senator Warren saying Elon needs to pay his fair share of taxes. I'm like, he's got a $15 billion tax bill. Like,
yeah, he's about to put the biggest, not his fair share, or like what? Pay the biggest tax bill in I think history of any individual taxpayer in a year. I think, yeah.
Yeah, it's just like so infuriating. But anyway, as for the question itself, I personally don't think there will be another performance plan. I think he's got his mindset on SpaceX and getting the Starship figured out and Mars colonized. I think if I'm reading between the lines of Elon's intentions, I think he needs to get autonomy kind of solved. And if he does that, he doesn't frankly need another kind of like employee or CEO incentive award to get that done. So I think it may be more of an attack vector to have something like that where he's awarded like another 10 million shares or something like that. Because he's going to have all the upside he really needs. Just you can imagine if the stock 4 or 5x's if they solve autonomy, then he's got all this cash flow he can use to fund Mars. Like that's all he needs. So I don't think there will be another performance plan, but we'll see.
Next question from Martin Muldoon. What's the latest with Austin ETA?
Seems really soon. I mean, everything I've been seeing says they're doing kind of like limited production right now. I kind of think they'll do something like, I think Shanghai started like right at the very end of December. What was that in 2020? I think it was, right? Or was it 2019?
I couldn't remember. One of those years. Yeah.
So, I mean, it seems very similar. I don't know, whether it'll be a few weeks here or there. It doesn't really matter from my perspective, but I think you'll have limited production in Q1 and just kind of ramping through all of 2022, just like you saw with Shanghai a couple of years ago.
I would agree. Yeah. From Yi Wan, why are you guys using non-GAAP earnings to calculate PE, forward PE?
That's what Wall Street uses. Nobody really looks at GAAP earnings. The biggest add back in there is stock-based compensation, which is a non-cash expense. So most companies will add that back, and that's the way Wall Street looks at it. So whenever you're talking about PE ratios, you want to use non-GAAP, not GAAP.
From Justin Matos, question: thoughts on yesterday's Rocket Lab acquisition of Sol Aero? Their webcast was interesting. If you haven't watched it, I have not seen the Sol Aero webcast. But yeah, I think Rocket Lab is just trying to become end-to-end space services launch provider all in one, and this is just another piece of the puzzle they're adding. I like it. I think it was a few tens of millions of dollars they spent on it, but it just helps complete their total solution they can provide. So, I mean, the stock's up today. It's been down a lot the last few days. So maybe the stock's reacting to it today. Hard to say. It's not a very liquid stock, so it could just be, one institutional buyer just coming in to say, let's buy 1 million shares of Rocket Lab or something. So who knows why the stock's up, 7% today. It could be that, but I'm happy with. I like it when they make strategic acquisitions. I'm confident in Peter Beck's ability to assess the strategic acquisitions. If it wasn't for Peter Beck, I would be suspicious, but I do have confidence in him just listening to him enough. What do you think, Matt?
Yeah, I agree. I mean, I don't know too much about Sol Aero yet. To be honest with you, I need to dig into it a little bit more, but it's been part of their overall strategy, so it's not surprising at all. I mean, they've been talking about this as one of the reasons that they went public, so that they would have that kind of public currency that they could use for acquisitions in order to vertically integrate. They've one just example of this is they've got this very strange fairing situation on their upper stage. I guess technically it's actually connected to the first stage. But like that's going to require some very precision deployment of the satellites or the second stage to make sure you don't like bump into the fairings on the way out. It's going to be really important to get that right. And one of the acquisitions, I forget the name of the company, but one of the acquisitions that they made in the last month or so was a company that specializes in exactly that type of equipment that you would want in order to kind of like precision launch your payloads. And that's going to be critical. So they're going to be doing a lot of stuff on the manufacturing side, on the payload side, on all sides, really, to vertically integrate. And we should just expect this to continue.
Question from Cully. In regards to the FOMC meeting tomorrow, if the Fed announces an acceleration in the rate of tapering, do you expect the macro environment to drag Tesla down further? I mean, I think the market's sort of pricing in bad news from the FOMC meeting tomorrow. I hope that's what's happening. So hopefully it's being priced in already, but there's no telling if they, do announce an acceleration in the rate of tapering that we still, maybe it's only half priced in right now and the rest of it will be priced in after that. So it's hard to say. I mean, also they could announce an acceleration in the rate of tapering and all stocks start going back up, like the market seems to do what we least expect in a lot of times. So yeah, maybe it's already priced in. It's like sell on the rumor, buy on the news. Always people say buy on the rumor, sell on the news. Maybe this is a case where people are selling on the rumor and then they'll buy on the news or something. Yeah. It's hard to say, we'll find out, I guess, soon enough. Yeah. Next question, Super John Bond 31 on Twitter. You once said you were desperate to not find a new stock like Tesla. Would you say you have found now? And what is it? To not find a new stock. I think he meant to find a new stock like Tesla. Yeah. So I don't know if I'm desperate to find a stock like Tesla. That's not the right. I don't know if I would have used that word desperate, but maybe I was looking for another stock like Tesla. I've always been looking for another stock like Tesla, and it's hard to say. I mean, Tesla is I'm increasingly thinking it's the stock of all time. So I just don't know. If it's the stock of all time, there's no replacement for it in my mind. So it just I'm not sure. What do you think, Matt? Do you have anything as a stock like Tesla you can think of?
No, I mean, we like a lot of companies right now, obviously, but I don't think there is. I think it's not maybe it's not a helpful framework to think of things as a stock like Tesla. I mean, it's a stock that went up like 20x in 18 months. Like, of course, I'd love to find another stock like that. But I think the key thing is just finding fundamentals, and like the more I studied Tesla, the more bullish I got on it, even as the stock was rising, and that's unusual. I mean, normally as a stock is rising, and you're not going to be raising your own kind of internal price targets, but just as Tesla continued to execute, that was what you saw happen, just like over and over again. And again, this quarter, I mean, we just saw it looking at the earnings per share a couple of minutes ago, like how big of a surprise essentially the last two quarters of earnings were. And so then that kind of resets your expectations for what earnings are going to be going forward. So yeah, I'd love to find another company that can kind of continually surprise to the upside with their operational excellence. I just don't know what that company is right now.
Yeah, let's do one more question. I know I said we go to I just have another meeting I got it ready for. One more question here. Life at 130 beats per minute BPM. With the recent market volatility and upcoming Fed meeting, are you doing anything to hedge your portfolio? I mean, we've been talking about hedging our portfolio. Matt and I privately talk about it a lot. It's asked of us a lot. Basically every other week there's a big scare going on that's been happening since as far back as I can remember. And most of the time when we try to hedge it, it's a drag on our performance. And so we don't usually act on it. And And on my personal account, an anecdotal story, I tried to buy some Tesla puts because I was like, after Elon started discretionary selling, the stock initially went down from like 1,200 to 1,100. I bought a bunch of like 900 puts to hedge my personal portfolio, and those expired worthless. So I lost 4 or 5% of my personal portfolio just buying those puts to hedge it. And I expected that to probably happen, but those were like 2 or 3 weeks out, and they're expensive. So hedging Tesla in particular is very expensive. And Matt and I have talked about it in the past, and we can't really buy puts for some certain, they're just so expensive. So we've looked at other potential things. We haven't found a real good hedge, whether it's like ARK investment puts or other stocks that are correlated to Tesla. And we really believe in it long term, and the short term price movement is hard to predict. Sometimes we try to predict it on the bullish side, but on it's like it's very hard to hedge a growth stock portfolio, a growth tech stock portfolio. Obviously Monday morning quarterback, you can always do it when there's a collapse like this and say, hey, we should have hedged it 2 weeks ago at start of December. But the first week of December, we thought that the first 3 or 4% down move was just kind of a fake out, and sure, it's continued since then. But yeah, it's difficult. There's probably dozens of times this year we've talked about hedging our portfolio, and if we had done it every time, our performance would be really bad by now. But it's just you got to pick and choose, and we just didn't do it this time very well. But we're always open to looking for ideas to hedge our portfolio further. You have anything you want to add, Matt?
Yeah, I mean, I think you hit on all the things. I mean, it's you kind of pay through the nose on implied volatility if you want to do it with puts, and then with shorts, if you just want to go short equity, then you're locking up a massive amount of capital in order to have any sort of meaningful hedge. So I think our focus is just to kind of focus on the fundamentals, and to the extent we had any extra dry powder, it would certainly help to kind of reallocate now. But looking forward into next year, I mean, we just walked through this model that makes me feel kind of very bullish about the short and medium term opportunities. So I'm personally probably not going to hedge anything in my own personal portfolio, and we just found it's probably too expensive to do it on the fund side. So we'll continue to look at that. I mean, if the macro market changes, if we see signs of kind of like some major deterioration or potential threat that's, has more substance than, just kind of like a generic concern about rates and tapering, I think we would certainly be free to act on that. But right now it doesn't seem worth kind of the performance trade-off.
Yep. Good questions. So. All right, guys. Well, we went on a little longer. Hope everyone enjoyed it. Well, this is recorded. I'll post right to the YouTube live channel once we're done, and we'll try to cut out the segment of the model on YouTube for a separate video for people that just want to see the earnings preview model and us go over the spreadsheet. I think that'll be a good kind of 20 or 30-minute segment to cut out for people focused on that. So yeah, we'll see you guys next week, and thanks for listening.
Actually, I think Emmet, you won't be in next week.
So I won't be in next week. That's right.
We're gonna have Yashu actually stepping in for Emmet. So hopefully we'll have some good juju on that, and we'll have a turnaround of some of the stock performance lately. But thanks everyone for watching.
Good. All right. Thanks, guys. All right.